So I'm going to give you 7 steps on how you can start investing in the stock market as a complete beginner. So the first thing you need to do is to get your finances sorted out. Now, I've seen way too many investors, they just put in money that they cannot afford to lose, and some worse, even put their life savings and also their children's school fees, they just put it in. So there are 3 main components. The first one is you need to understand what are your financial goals. Now, do you want to invest to have a good retirement, or do you want to invest so that you can pay for your children's school fees within the next few years? It's very important to understand this, because if you want to generate income within the next few years, then the stocks, assets that you invest into are going to be very different as compared to if you were to invest for retirement. Even your portfolio allocation, your asset allocation is going to be different. And like I said just now, before you even start investing, okay, make sure that it's not the last amount of money that you have. Like if you lose that money, you're gonna get homeless. Then don't invest. You're not ready yet. Make sure that before you start investing, you have a proper emergency fund. Basically at least 6 months worth of expenses. Next thing you're gonna understand is your risk tolerance, okay? Now this applies to traders and also investors, because if you're a low risk person, you don't really like to take a lot of risk, then your portfolio has to have more bonds as compared to stocks. Even if your portfolio has a lot of stocks, most of it will be large cap stocks, meaning safer stocks, okay, more stable stocks. Whereas if you're a high risk taker, then majority of your portfolio should include small cap to mid cap stocks. They are more risky, but then the potential for upside returns is a lot more as compared to large cap stocks. So see, all of these things are going to determine what kind of stocks you buy. So many investors just invest into stocks because somebody else recommended it without even considering all this stuff. Now, second step you need to take is be a student of the stock market. You'll be surprised with how many investors actually skip studying it altogether, and they wonder why they lose money. I don't know if you can see over here, there's a big bookshelf, and a lot of the books I have are stock market books, and I take my time to study. Personally, I've spent more than $60,000 to learn about the financial markets, and there are people complaining about $600 costs. The best investors in the world are willing to invest in themselves, okay? Now, the first thing we gotta learn about the stock market is what drives the stock market. Now, there are many different factors. The first factor, in the short term, the stock market is driven by emotions, fear and greed. So that's why you see a lot of times when a company announces good earnings or there's good news associated with a company, but then the stock still went down because of temporary emotions like fear and greed. The stock can be fundamentally good, but it can still go down in the short term because of emotions. And in the long term, it is driven by fundamental reasons. So you gotta look at the numbers, the balance sheet, income statement, and cash flow statement. And it's also going to be driven by global macro factors. So you see major events like pandemic, war is going to affect the stock market in the short term. And the fourth factor, economic indicators. Now this is not that important as compared to these factors, because a lot of times economic indicators, they are lagging, especially indicators like GDP, employment data, they are all lagging economic indicators. So don't use those to predict the future. And like I mentioned just now, short-term news like announcements is going to move the stock prices erratically in the short term. So a lot of times when there are bad news, good news coming up, don't pay attention to them, because they are just going to affect the stock in the short term. And of course, this all comes down to market sentiment. Now, I have a whole course on YouTube about sentiment analysis. It's going to help you whether you're a stock investor, stock trader, forex trader, when you learn to read sentiment, a lot of times you realize that everything is connected to each other. Okay, then the next thing you gotta do is to determine the type of stocks to buy. Now there are different categories, but if I'm to classify it properly, okay, so you have stocks that can be classified in terms of performance as well as market cap. What type of stocks you pick from here is going to be determined by your risk tolerance, because there are two types of stocks: value stocks as well as growth stocks. Okay, now value stocks typically they would have a lower PE ratio. Okay, PE ratio meaning price to earnings ratio. Alright, whereas for growth stocks, investors would tend to pay a premium for growth stocks, meaning that these stocks will tend to have higher PE ratio as compared to value stocks. A lot of times investors would chase stocks that are growing really fast in terms of sales, earnings, whereas for value stocks, investors would tend to buy stocks that are below their intrinsic value. So if you are a conservative kind of investor, then you would opt for value stocks. If you are a risk taker, then you would pick growth stocks. Okay, then for market cap, you have small cap stocks, mid cap stocks, as well as large cap stocks. Now if you are a risk taker, then you would pick the small cap stocks. Okay, now cap, it represents market capitalization. Okay, basically it's the price multiplied by the number of shares outstanding. To put in simple terms, to put in simple words, it basically tells you how big the company is. Okay, so small cap stocks meaning like small companies but they have high growth potential. Large cap stocks meaning they are super big companies like Walmart, Apple. Large companies, established companies, famous companies, but then the potential for growth is very little. But then they are more stable, okay, less volatile as compared to small cap stocks. So if you are a conservative investor, then you would have more large cap stocks in your portfolio. If you want proper diversification, you can have a mix of small cap and large cap stocks. And very important, you should treat these two almost like two separate asset classes. Okay? Because one is more risky and then one is more stable, less risky. There's also another classification, US stocks and foreign stocks. Now most investors, including me, would invest into US stocks because of the higher liquidity, the size of the market, the US stock exchanges, as compared to foreign stocks. Like emerging market stocks, they tend to have more growth potential, but then they are also more risky. Okay, then the fourth step is research and filter out profitable stocks. Now there are just three main things to picking successful stocks. The first one is that the company must be in the right business. Now remember, when you're buying stocks, you're buying a portion of the business. It's not just a moving ticker symbol on your chart, it is a business. So before you buy a business, ask yourself, am I willing to become a part owner of this business? So one of the ways to pick the right business is to understand the different types of industries. You might prefer tech stocks. Some people might prefer more conservative stocks like utility stocks, consumer discretionary. Again, this depends on your risk appetite. Okay. Now Warren Buffett, who's the goat of value investing, okay, always preaches this. Always invest within your circle of competence. So that's why it's not okay for you to go around asking people, so what stock should I buy, what hot stock should I buy right now? Because if you don't understand business, then you're literally gambling money. So let's say if you work as an employee in the healthcare industry, then you might understand the healthcare industry a lot more as compared to, let's say, tech stocks. And if you're not working in any company, you're jobless and broke, then look around you. What are the products that you use regularly? Now, one very important thing. A good product or service doesn't necessarily mean that the business is a good investment, because there are some companies like they sell good ice cream, a lot of people buy them, but then when you look at the numbers, they are not profitable every single year. Okay, this is very important. So the main thing we are look at are the numbers, which I'm not going to explain in this short video. If you want a more detailed course on the specific numbers you need to look at, let me know, okay? Then the second thing, aside from being a right business, it has to be managed by the right management. It's very hard to tell sometimes, because when a company publishes an annual report, of course they'll say good things. I'm gonna do this, I'm gonna grow the company, I'm gonna make it a $1 billion company. They can say everything they want. So how do you know whether do they really preach what they say? Again, look at the numbers. Look at the past 5 to 10 years. Are the profits increasing at a good rate, or are the profit margins going down and down and down and down and down? Okay, and look at their past promises. Let's say if 5 years ago the CEO said, I'm going to invest and build a power plant. Then when you look at a few years later, right now, nothing is happening. So then you got to question whether is this company operated by the right management. And this one is very important. Make sure that when you're buying the company, it's at the right price. Now, a lot of beginner investors make this mistake, is that when they see a company that is cheap, okay, they're gonna buy straight away. But cheap is relative, because if you look at the real true value of the company, which is the intrinsic value, let's say if company A has an intrinsic value of $100 and their current price is 120, and then for company B, let's say their intrinsic value is $5,000, okay, but the current market price is at 1,500. Now for a beginner investor, when they look at this without knowing how to calculate the intrinsic value, they're gonna buy this because it looks cheaper. Whereas for a trained professional investor, when they look at this, oh my god, the margin of safety is so big, the risk to reward ratio is so good, it is undervalued, so this is a good buy, even though this looks more expensive than this. Now the thing is, you can pick the best business, best management with the best numbers. You will still lose money if you don't enter at the right price. You know what I'm saying? And also you realize a lot of times, good companies, they tend to be relatively more expensive as compared to cheap companies. Look at penny stocks, how cheap they are, but then most of them go bust, and then a lot of investors lose money because of that. So as a beginner, try not to dabble into small cap stocks and also penny stocks, okay? So in order to find a good business, profitable stock, you can use a stock screener. And just now, like I said, you can look at your personal surroundings. What products do you use to generate ideas? And also there are also websites, stock research websites that can give you good ideas. And one of those websites that you can get your stock ideas is Seeking Alpha. So let me show you real quick. On the left column over here, you can see you have the top stocks, top ETFs, and this is under the premium service of Seeking Alpha. Okay, so let me just click into this and you see all the top stocks with 3 different ratings. And these rates are based on the currently available data, okay? And this portion, SA analyst ratings. So basically in Seeking Alpha, there are various analysts that cover this stock, and this is the average ratings based on their analysis, okay? And this one is based on the Wall Street analyst. And remember when I always tell you that You cannot just rely on analyst rating and blindly follow them. You can use it as a confirmation to your own analysis. And if you move over to the right, you see all the other various metrics like valuation, growth, profitability, momentum, EPS especially. Now the good stocks, the great stocks, over the past 100 years has growing and stable EPS. Okay. So aside from that, under the premium service, you can also use their stock screener to find great stocks to invest into. And over here, you can click on advanced filters and then you'll be able to filter out everything based on the various metrics. Okay, dividend yield, earnings, valuation, growth, performance, and you also have an ETF screener over here. Okay, and again you can filter out using the various metrics. Okay, aside from that, you can also compare 6 stocks or funds side by side. So what you need to do is to create new comparison. So let's say you want to compare Apple stock with Dell stock, SMCI, which is also what I bought. Just click compare. And then you'll be able to see, okay, the comparison in terms of market cap, enterprise value, employees. Aside from that, when you scroll down, you can also see the comparison in terms of the price movements as well as the ratings. So as you scroll down, there's a lot of different types of data that you can use to compare as well. Okay, total returns, dividends, dividend grades is a very detailed comparison. See, growth comparisons, valuation comparisons, so that you don't need to switch between different tabs, different websites, different financial statements, and it's gonna take you a lot of time. So that's why I like this tool a lot. It's very useful. Okay, so if you also want to sign up for this website, I'll put link down the description below as well as the pinned comment, and when you register through my link, you'll be able to get $25 off, and also they are giving you a 7-day free trial. Now the next thing you gotta do is to choose a good stockbroker. Now the first thing we gotta look at fees and commissions. Now way too many investors, even traders, they make the mistake of picking a broker that offers the lowest fees, lowest commissions, and they just use that. That's not the right way to approach that, because there's a lot of competition nowadays in the brokerage industry, and in order for brokers to attract more clients, they will want to decrease their fees as much as possible. And if you're not careful, you might pick a scam broker with super low fees or no fees at all, but then when you want to get your money back, then that's the problem. So the most important criteria, okay, to ensure that your funds are safe is that they must be regulated by a good, keyword good, financial authority. Now here's the thing, there are a lot of brokers who are regulated by certain country. They are not so good. When you see a broker that's regulated in St. Vincent's, Cyprus, gotta be careful. Whereas if you see a broker that's regulated by FCA, Australian Securities Investment Commissions, CFTC, these are safer options. Okay, for Singapore, this Monetary Authority of Singapore, MAS. Because the thing is, when brokers, they couldn't meet certain criteria, for example, ensuring fund safety of funds, then they are going to go to some countries where they can get their license, their regulation easier. I've seen brokers tell me, you know what, my brokerage company, there are certain things that didn't meet the criteria, you know what I'm saying? So I'm gonna go all the way to a random island, I'm not gonna mention the name, okay, and then get a license there. So that's easier for me to do business. then I'm like, okay. And of course, make sure that the trading platform is user friendly. Okay. And how do you know whether the broker cares about you or their own pockets? Check their customer service. Ideally, they should have 24/7 customer service. Test their customer service, okay? If you go into the chat and then some virtual agent called Anna pops up and be like, how can I help you today? And then you reply, I couldn't get my funds out. She replies, I'm sorry, could you repeat that again? I couldn't get my funds out. I'm sorry, could you please repeat that again? As a bonus, if the broker has a comprehensive research tool, then it's good, because there are some brokers, their platforms have a stock screener installed inside, so you don't have to separately go to another website for a stock screener. Then the next thing you gotta do is to open a virtual stocks account. Now please put in the time and patience. Give yourself at least 6 months to practice properly. Okay? What is 6 months as compared to some people spending 40 years just working a 9 to 5 job? And yet a lot of investors are not willing to put in the time, and they wonder why they're not making money. And avoid, okay? Trading stocks within your stock investment account, because if let's say you have one account and you mix your stock investments with your short-term stock trades, it's going to be very confusing for you to track your performance, because the purpose of a virtual stock account is to make sure that you are competent in picking stocks and holding it in the long term. So if you want to trade stocks while you're investing, open 2 separate accounts. Okay? Even when you eventually go into live account, make sure you separate them into 2 separate accounts, or better yet, 2 different brokers, because there are some brokers, the fees, trading conditions are more suitable for stock trading. Then there are some brokers, the fees are more suitable for stock investors. Because there are 2 main types of brokers. The first one, it used to be called discount brokers, but nowadays we just refer it to online brokers. Okay, these are suitable for both stock investors and stock traders. Whereas if you have more capital, you can opt for full service brokers. Basically, you have to pay more because they'll give you more investment advice as compared to an online broker. And it's normally for wealthy clients with more than $100,000 in capital. So as a beginner, you probably go for online discount brokers. Okay, and next time when you have more money and you don't have time to manage your own account, then you can opt for full service brokers. Now the 7th step is to monitor and track your performance. Now this is going to determine 2 things, because eventually you need to rebalance your portfolio. Okay, and this is a whole topic itself in asset allocation. Okay, what portion of your portfolio must comprise of stocks, bonds? Now there's no fixed way to determine that, but you can use this as a guideline. Okay, take 110 minus your age. Let's say you're 30 this year. Okay, 110 minus 30 gives you 80%. So this means that 80% of your portfolio should comprise of stocks, then 20% would comprise of lower risk assets like bonds. But of course, this is just a rule. You can be more flexible with this. Okay, and how often should you track your portfolio? You don't need to look at it every single day. You can do a monthly or quarterly review. Okay, and also most importantly, you gotta track your performance, monitor it, so that you know when to sell your stocks. Now this is very important, because a lot of investors sell it at the wrong time and then they regret. So when should you sell and when should you not sell? Way too many investors sell when the market is temporarily down due to a recession or because the company is engaged in a temporary lawsuit, but the stock is still fundamentally good and they sell out of fear. Now the best hedge fund managers that I've talked to, okay, they will buy more of that good stock when the market is down, and then they will sell a lot of their stocks away when the markets are overvalued, are very high. Whereas for a lot of beginner amateur investors, they do the opposite. They sell out of fear when the market is down, and then they buy more when the market is climbing up and up and up. So when should you sell? You sell only when your stock has went beyond the intrinsic value. Okay? Or you realize that, oh, I made a mistake during my research. Or the company no longer has good valuation, good growth prospects. You can also sell it when you realize I have put too much capital into this one stock, meaning your risk management is a little bit off when you first bought it. You bought a little bit too much shares, too many shares. So it was a mistake, then you sell off some shares. And also, hopefully this doesn't happen to you too often when you need the money right now. So let's say you need to pay for your car that broke down and you didn't expect that. And when you're tracking your performance, okay, try not to be like the typical retail investor, retail trader who just look at returns. Now you know a trading guru don't know what he or she is saying when all he or she preaches is returns, because if you really studied finance, you understand that returns mean nothing because it is all about risk-adjusted returns. So instead of monitoring how much percentage ROI you're generating this year, this month, you gotta look at Sharpe ratio. This is the measure of your risk-adjusted return. Basically, this takes into account the volatility of your portfolio, how much risk you are taking, okay? Because when you only focus on returns, you could risk your whole entire portfolio to generate 50% return, 80% return, means you're completely ignoring risk management. Now, if you want to go to the next step and learn how to pick stocks, I've done a video quite a long time ago. If you want me to make a new one, let me know. So I'll put a video somewhere here on this screen. So with that, I'll talk to you in the next video. Bye.